The next question that we have relates more towards mutual funds and ETFs and expenses. The question is, I hear a lot about MERs, management expense ratios, on mutual funds and ETFs, and I see that you hold funds and ETFs in your portfolio. Can I really retire 30% better if I focus on minimizing fees? Now, there's a ton of messaging on TV, radio, and the internet about fees. And yes, it is important to stay on top of your fees that you're paying for investment management, but not all fees are created equal. There's a common theory in the investment industry that only 20% of investment managers beat the index. And logic, therefore, suggests that you should simply buy the index. From our point of view, we live in a very technologically advanced world. So why not use technology to search out managers who consistently outperform the indices in both positive and negative markets and avoid index huggers and underperformers? Now, we use mutual funds and ETFs in our portfolios, but for a strategic purpose. We manage the bulk of the portfolios by managing much of the stock exposure ourselves. But we focus on big companies that have a long-term track record of consistent and predictable earnings. By buying these directly, we avoid a second layer of costs. The funds and ETFs are used for diversification. We look for managers who manage small cap companies in international markets or have a specialty that could enhance the portfolio returns. We don't want to be a single factor manager, and specialty managers help us to diversify the portfolio. But we don't just pick any old manager. We look for managers in a particular space who fit the 20% who outperform the particular benchmark on a regular basis and actually earn their fees. Sometimes we pay a performance fee on top of regular fees if the manager has an exceptional year. Bond funds are a particular area for which you should be very careful regarding fees. When interest rates are below 1%, you should avoid buy and hold bond funds because the fees are higher than your expected returns. Many balanced funds are worse because stock MERs are higher, and balanced funds often have equity MERs, so that you're paying a manager 2% on the bonds that you're holding that are yielding less than 1%. That just doesn't make sense to us. We avoid traditional bond funds for that reason, and we focus on private debt and absolute return bond managers who actively trade and work strategically. But we don't do these unless we have confidence that there's a high probability of generating returns to justify the fees.